When it comes to the Asian markets, Sean, what are you closely watching now that we have the CPI numbers and we're headed towards the FOMC?
Well, I think there's two things for this time zone. Certainly, the difficulty for Hong Kong is that matching a sort of 75 or possibly 100 basis point rise is going to mean a quite considerable tightening in financial conditions. And on the second side of the ledger is the exchange rates. As you've alluded to in your report, the dollar is going to continue to get a firm bid, and alongside China actually having quite deflationary pressures. China's PPI numbers yesterday came in well below expectations and showing that they actually still need to cut rates. It's going to put pressure on Asian exchange rates to weaken. And I think, unfortunately, there's room for the Chinese currency to trade on the softer side of 7 going forward.
So let me ask you, Sean, then headed towards the FOMC meeting, what's the best trade? I mean, we had been asking our MLive Pulse question of the week about the best trade ahead of the FOMC. Some of the options there were, are we going to see a deeper inversion in the 2 cents? Something that we've seen after the US CPI number. Some other options were long growth, long value. Do you have a certain trade that you like?
Well, I agree that the curve inversion is going to remain much deeper and for much longer now. And I think both the 2 and the 5 and the 2 and the 10 are going to remain entrenched pretty much going into 2023. Probably the best trade still is to go long volatility. Credit spreads have been actually relatively benign over the last couple of weeks, but FX volatility always leads overall asset volatility. And hence, I think that would be the best trade going into the FOMC.
Sean, is the pivot now off the table, or is there an argument, as Al Garfield Reynolds is arguing, that if we get 100 basis points, it actually takes us closer to that being the last jumbo move and perhaps even closer to a recession, which would mean we're closer to a rate cut cycle?
Yeah, I have some sympathy with that view. I've had some sympathy with that view, and it's not necessarily been right. I think the irony is that whatever the Fed does now at the FOMC, it's likely to mean that rates remain on hold, and I don't think that's necessarily the news that the equity markets had wanted to see. I think paradoxically, yes, you'll get may even get a spike of 100, but it may actually, the way the yield curve is performing is saying that these rates are going to remain quite tight for quite a considerable period of time, and I think therefore we're not going to get those relief rallies that people had anticipated, including myself, I have to say.
Does China then become a good alternative, given, as you say, inflation remains low, still stimulus remains forthcoming?
I think if you can sort of hedge the Chinese currency, I think that's actually a very reasonable assumption. I think we have to take into account that this is probably one of the weakest periods for growth for China coming into the Congress. And certainly I don't think there's going to be any major announcements until after the 16th meeting. The only issue is that I do feel that the markets will try to pressure the yuan to break through 7, and that in itself, I think, probably lends itself to more being in the CSI 300 than the Hang Seng. I think the Hang Seng will take news of the breaking in the currency, breaking that level pretty poorly.